Following the implementation of the Retail Distribution Review, there are now new requirements on the standard of independent advice for personal recommendations to retail clients. This advice must include a comprehensive and fair analysis of the relevant market and be unbiased and unrestricted. The relevant market is defined as retail investment products which are capable of meeting the needs and objectives of the client. There are now a number of investment vehicles covered by this wide definition of retail investment products that were not covered under the previous packaged products terminology. So advisors will need to increase their understanding on how these new requirements must be applied. One of the most notable investment vehicles that will now be covered under the definition of retail investment products are investment trusts. Although investment trusts are not a new investment vehicle to the market, they are now a growing investment channel and have benefits including diversification, efficiency and access, cost and transparency, and effectiveness. Aberdeen Asset Management are one of our key strategic partners and are experts in investment trusts. With the support of Kenny Harper from Aberdeen Asset Management, this CPD module will aim to help advisors have a greater understanding of investment trusts, understand the benefits of investment trusts, understand the role of the board in regard to investment trusts, understand further technical aspects of investment trusts such as gearing, discounts, premiums and charges, and also understand the Tenet approach for advising on investment trusts. Kenny is a graduate of Edinburgh University and a fellow of the Chartered Securities Institute with over 20 years' experience in the financial sector. 15 of these have been directly related to the closed-end sector, initially as an investment trust analyst and fund-of-fund manager at Brewin Dolphin before moving to Glasgow Investment Managers GIM as head of investment trusts. Kenny joined Aberdeen Asset Management in 2007 on its acquisition of GIM.
I think probably the most important thing for advisors who aren't familiar with investment trusts, or as they should be called now, investment companies, is that they're not entirely different beasts from mutual funds such as unit trusts and OICs that clearly are a much bigger part of the market at the moment. The crucial difference is that they're publicly listed companies, or PLCs, companies in their same rights as Shell or Marks and Spencers that are listed on the UK Stock Exchange. They aim to generate profits by investing their capital in a portfolio of assets, and that's absolutely in the same way as the open-ended funds do. Indeed, there's a lot of managers of unit trusts who manage almost identical portfolios, except that the structure is that of an investment trust. So they're professionally managed in exactly the same way as unit trusts and OICs. Generally, this is by a manager who's employed by a large investment house. But occasionally you find in the investment trust sector independent investment trusts that were set up many years ago, quite often, by a very wealthy family. One of the most well-known trusts at the moment is RIT Capital Partners, which is the saving vehicle for Lord Rothschild. The trust, as is any company that's listed, is governed by UK company law and owned by their shareholders. Now, they can be based onshore in the UK, or a number of trusts have been set up offshore in the Channel Islands, Guernsey or Jersey. This was originally done because there were tax benefits. Indeed, there are still some slight tax benefits there, but not as many as used to be the case. Another important part for advisors to recognise is that investment trusts have a fixed numbers of shares in issue. I mean, this can be varied, but by and large, when a trust is set up, a specific amount of money is raised and a specific number of shares are issued. This does occasionally change when a trust, for example, has maybe been trading at a large discount and the board takes a decision to buy back and cancel shares, or the reverse being it's been trading at a premium, and the board decides that they're going to issue some more shares. Now, I mentioned the board there, and it's an important part of an investment trust that they have boards that are independent from the investment manager. This is totally different from a unit trust or an OIC, and this board is there to oversee the interests of shareholders. Another specific attribute of investment trusts is that income can be distributed as dividends to shareholders. There's a rule that says 85% of all income has to be distributed, but this actually allows 15% to be retained, and that can be kept as in the revenue account, and it enables investment trusts to smooth the dividend payments. Profits now, actually, it's a recent change that capital gains can now be distributed as dividends as well to shareholders. To enable this, though, the board will have to get approval from shareholders, as indeed they need to do for most structural changes or changes in investment mandate. The benefits of an investment trust are actually very similar to the benefits of investing in a mutual fund. As I said earlier, it pools investors' money together, therefore spreading risk across a collection of assets, stocks, that an individual investor most likely would not be able to achieve in a portfolio of their own picking. I mentioned before professional management. Most companies that are running investment trusts, along with unit trusts, have dedicated teams of professionals whose role may be to research either specific sectors, whether it's pharmaceuticals or small cap perhaps, and also across geographic ranges. My own company, Aberdeen, is well known for its expertise in Asia. Quite often, I mean, it's not just individuals that would find it very, very difficult to invest in Asian companies. There are institutions in the UK who may have a UK equity team or indeed fixed interest team, but themselves acknowledge that they don't have the expertise of investing in Asia or other emerging markets, and therefore they take the opportunity to put the money in to a unit trust that invests there, or, as happens quite often with us, into an investment trust. And they get the benefit of professional management in an area that they themselves do not have. Looking at investment trusts in comparison to mutual funds, historically there have been lower charges on investment trusts. Some of the old investment trusts indeed have total expense ratios of less than 0.5%, which compares very favourably with unit trusts and OICs. I think the new RDR regime will probably change that. I think a number of unit trusts and OICs will become far more competitive on charges, but it is something an investment advisor should always look out for when they're looking at vehicles. Check out the charges, how much is this going to cost. Another beauty about, again, this applies to unit trusts and OICs as well, you can invest small amounts on a regular basis, for example, and rather than going direct and buying a few shares in Shell. I mean, it's very, very easy to invest in investment trusts and get great exposure all around the world. Beauty of the pooled fund is that there are no capital gains tax on investments sold within the company. So if for an individual were holding a portfolio in their own right, whenever they make a sale, if there's capital gains on that, tax will be due above the limits that they're allowed. Fixed capital. This is probably one of the most important parts and advantages for an investment trust. Because there's not inflows and outflows as much as with unit trusts, the manager can take a long-term view. He doesn't need to sell. The selling gets done external to the fund manager when shareholders decide to buy or sell. Also, investment trusts, because of this fixed capital, it can provide more effective access to less liquid asset classes. It also can take a very long-term view. There's no need to sell something just because there's cash flow. There's no drag in performance from cash, so unlike mutual funds, the manager does not have to consider inflows and outflows. As mentioned before, investment trusts have fixed capital, and this really allows the manager to take a long-term view and also hold less liquid asset classes, whether it be small cap or Asian small cap, property. Indeed, there's a number of trusts that have forests that are there. Also, there's one, believe it or not, that's oil rigs, oil rig financing. These are not mainstream investment trusts, but what it does, it shows that they can take this long-term view, and they never have to buy or sell assets like that. Private equity probably is the best example of a sector in the investment trust world that doesn't exist in the open-ended world, and that's because there's no cash flow, no dragging performance from cash like the open-ended funds. A manager managing a mutual fund, on a daily basis he has to buy some assets if there's redemptions from the fund, or indeed put some cash to work that's come in. It quite often leads to him holding fairly large cash positions, whereas an investment trust, the manager can be fully invested all the time because any sales or purchases of shares don't affect him. It's done externally to his management of the fund. Again, as I said, open-ended funds, in times of great volatility, quite often they'll see a rush for cash from investors, which can lead to the manager of an open-ended fund having to sell, stock that maybe he wouldn't want to sell, but it happens to be liquid stock, and he has to sell it simply to meet people's redemptions. The role of the board should never be underestimated. I sit in quite a lot of board meetings, and it's a job that directors take incredibly seriously, in that they know what they're doing and is representing shareholders. One of the roles of the board is to determine how the fund should be invested. So this can be deciding whether or not, if a particular market is suitable, maybe they decide, let's open it up and go 20% in Europe or something like that. A critical one that is very much left to the board, generally on advice from the manager, is its gearing policy, which I'll discuss a little bit more about later. One of the other very important duties of the board is for them to check that performance is up to scratch. Now, quite often what happens, if there's been underperformance for a period of time, there's a variety of things that the boards can decide to do, whether it be argue for a reduction in management fee, introduce a performance fee perhaps that with a basic reduction to the annual fee. But it can actually lead to the board deciding that they're going to put the investment mandate out to tender, and they will have a beauty parade and choose from that stage who they think the best manager for the job is. So quite recently, a number of trusts have actually changed hands, something that you don't see in mutual funds. Another thing that the board have to do is, and I know for a fact that they really grill the fund managers for this, it's ensuring management fees are as low as possible. I think it's approaching 30% of all trusts have a total expense ratio of less than 1%. Indeed, some trusts are under 0.5%. Board is also responsible for dividend policy. As I mentioned before, an investment trust can retain 15% of its income to put into a revenue account. Another thing, though, that affects the dividends that are available to be paid is that the board will decide where fees are charged. Some companies, investment trusts, will have 100% of fees being charged to capital. Others will be 50% of fees to capital and 50% to revenue. And that clearly has an effect on the dividends that the investment trust can pay. A big role as well, of course, for the board is to communicate with shareholders. This is entirely the same as with some of the larger household company names that have to deal with shareholders. It is, in fact, one of the roles that I have in my day-to-day job. Mainly this is done through liaising with the private wealth managers who manage shares on behalf of their clients. Gearing or leverage simply refers to the ability of investment trusts to borrow money that they invest in the market. It isn't entirely different from what most individuals do when they buy a house. Indeed, when an individual buys a house, they actually are incredibly heavily geared into the property market. And obviously, there's a difference because people need to live somewhere, but it's along those same lines that the money is borrowed because the manager, with approval from the board, believes that the cost of the debt that they take on board, they can achieve more by investing it in the market. One of the things that, it probably is crucial for an advisor to always look at the gearing level of any investment trust that they invest in. Because quite simply, if a trust is geared in a market that is going up the way, it's going to be a benefit for it. But of course, the opposite isn't entirely true. So in a falling market, gearing can seriously erode investors' wealth. As a market falls or the assets in a trust fall, of course, the gearing actually becomes even greater. So trust will fall even more. It's crucial that advisors are aware of that. But by and large, over a period of time, gearing has shown to be of benefit to investment trusts. There's different ways of gearing. Another thing that's incredibly important to appreciate for an advisor is that what sort of gearing is the investment trust using? Is it structural gearing or is it short term? One of the cleanest forms of gearing is very much similar to a human being who borrows a little bit of money from the bank in an overdraft form. This would be more sort of tactical gearing, where the manager will say to the board that markets are quite low, or I think there's a short-term opportunity. Debt is very cheap at the moment, and they can take a bank overdraft that they can invest in the market. Slightly longer-term view would be with a fixed-term bank loan. Again, nothing different. All companies can do this. Individuals can do it as well. So we're taking a slightly longer view. So this could be 3 months, 6 months, or perhaps longer. And it can either be at fixed or a variable rate, much in the same way as a mortgage can be for an individual. Debentures are slightly different. This is actually where the investment trust issues a bond as such, called a debenture, and it will pay interest to the debenture holders or bond holders, generally over a pretty long term, such as 20 to 30 years. This is a view. This would be considered more structural gearing in that it's such a long term. And the investment manager would look to be invested generally fully invested over the complete period rather than moving in and out. Debentures aren't so popular now. It's, for some peculiar reason, because interest rates are at an all-time low at the moment. One would have thought that managers would be more likely to issue debentures. But there's still a number of debentures around, something that all advisors should look at this gearing, because a lot of the debentures that have been issued in the past, maybe 15, 20 years ago, were issued at a time when interest rates were pretty high. So it's a very expensive debt. And for the manager to repay that debt early would cost quite a bit of money. Convertible bonds are exactly what you would perceive them to be with the name they have. This is when a manager or the trust board will issue a bond similar in a way just to what I was speaking about the debenture before. But at the end of the term, rather than getting the fixed capital back, they have the option to have their loan returned, or they can convert into ordinary shares at a predetermined price. Generally, that price would be based on the net asset value of the ordinary share at the time of issuing the convertible, plus a premium of, say, 15 or 20%. Again, advisors should look at this because there is a dilution effect on the ordinary shares by having convertibles. And floating rate notes, again, pretty obvious what they are. It's just a variable interest rate that resets regularly over a fixed term. And it protects the trust from losing out in times of rising interest rates. Well, the nature of investment trust, given that it's a closed-end fund listed on the stock markets, means that share prices are driven by market demand, unlike mutual funds. So this means that if there's lots of buyers of an investment trust share, well, the price will move up. And the reverse is the case. If there's sellers, generally the price will move down. Now, what this means, if the price is moving up, it will be accelerating perhaps quicker than that of its net asset value. So when we're talking about a discount, what we're saying is it's trading, the ordinary share is trading below its intrinsic net asset value. The opposite, as I said before, strong demand forces the share price up, and it can rise above its net asset value, and this is where it is said to be trading at a premium. How can these be controlled? Well, one option that the boards can do to this is to buy back shares. Investment trusts can buy a proportion of their existing shares. Generally, this is 14.99%. They get this permission renewed on an annual basis at the AGM by shareholders. And buying back shares helps to narrow the discount because it reduces the number of shares that are available in the markets, and the board can buy them back. Generally, as the case has been, that these shares will be cancelled, but there's another way that they can be held, and it's to be put into treasury. These are called treasury shares, and these are shares that have been repurchased. And the idea is that in future, if demand for the investment trust changes, that they will be able to reissue them. Tender offers are another particularly strong way of trying to limit or reduce a discount. This is an offer to shareholders to buy back their shares. Generally, the trust may say that they'll buy back a specific number, 15%, for example, on a 3-yearly basis. And this tends to mean that the trust should trade at a narrower discount. There are various ways for investors, whether it's private clients or advisors or wealth managers, to invest in investment trusts. But generally speaking, the costs associated with buying shares or in investment trusts are identical to buying, as I mentioned before, Shell or indeed any company that's listed on the London Stock Exchange. So this will generally consist of stockbroking or dealing charges. These vary, dependent upon the wealth manager. Some execution-only online brokers may charge as little as £10. One of the other things there is a charge, though, is a 0.5% stamp duty charge. There's no avoiding tax, it's a government charge, although I should say that if it's a new issues, i.e. a launch of a new investment trust, there is no stamp duty to be paid. Selling costs are identical to the purchasing costs except for the stamp duties. So again, advisors and investors should check with the brokerage what the charges are. This important one is the bid-offer spread. This really is the difference between what you have to pay to buy a stock and what you'll get back if you sell. This can vary between trusts, right? There's a critical thing. If it's a less liquid investment trust, the spread tends to be that bit higher and therefore pricier, more expensive for anybody who's looking to buy those shares. The biggest investment trusts, the most liquid investment trusts, have very, very minimal spreads, but there's no doubt that it can be expensive if you're looking at some of the less liquid investment trusts. Annual costs is another charge. There's no getting away from this. Most of the fund management houses receive an annual management charge to cover the cost of portfolio management. Again, this is in exactly the same way as the managers of mutual funds. There is also the ongoing costs of running the company like any other company. There'll be audit costs. The directors will have director fees. There'll be advertising costs if it does that, marketing, etc. Exactly the same as running any other company. These are costs that will all be revealed in the total expense ratio, though. So looking at the total expense ratio for an advisor is extremely important, especially if you're looking to hold long term, where the difference in a few basis points adds up.
Tenet has created an investment trust panel, which has been in place for some time but has recently been updated. This panel has been constructed following a comprehensive due diligence process. All appointed representatives must adhere to these panels and need to follow the off-panel process for using non-panel propositions. Tenet Select advisors can get access to these by signing up to the core research package. Tenet's financial planning services issued post-RDR guidance on investment trusts in mid-February 2013 to provide an update on giving advice on investment trusts in a post-RDR world. As with any other personal recommendation of a retail investment product, the regulator expects advisors to have conducted sufficient due diligence to be able to demonstrate that the selected proposition is an appropriate way of meeting the client needs. Tenet's financial planning services guidance provides an overview of the key factors to consider as part of this due diligence process. I hope you found this session useful. Thank you very much for watching.